If you actually understand what I'm about to show you, you'll never look at the chart the same way again. Let's cut the bullshit. You've probably watched a dozen YouTube videos on how to trade, or maybe you're just starting out. Doesn't matter. You still don't know what the first real step is. And there's a million different strategies out there. A million traders trying to sell you some dream, or a system, or some magic blueprint. But here's the truth. You only need one way to trade. One process that actually makes sense to you. I've been there. Information overload, no idea where to begin, and that's why I built something called Enter the Madness. My way of showing you what this world really looks like. From someone who's been through debt, failure, long nights, and clawed his way out. So from here on out, anytime you're stuck, anytime you're doubting yourself in trading or in life, just tell yourself, enter the madness. Now, let's get to it. I like to keep things simple, focused. I'm not going to bore you with 1,000 trading strategies or overwhelm you with theory. What I'm going to show you are 3 core strategies and how to understand structure so you can read the market, make sense of the chaos, and trade with clarity. Okay, so the very first strategy that you want to look at, and it's probably one of my favorite as an overall idea of when to enter and exit the market, is a trend following strategy. Now, you've probably heard of this, or you've probably seen this a lot, but not a lot of traders actually talk about what it entails. Now, following the trend means that you're looking at the higher time frame most probably, and you're trying to take trades based in the direction of the higher time frame. So I want to have a look at the daily time frame when I'm trying to look at the overall trend. And sometimes I'll even go as high as a weekly time frame just to have an overall idea of how the candlesticks are looking. So I'm on the weekly time frame and I can see that we have a bullish candlestick right over here. So this tells me that there's a lot of volume pushing the market up. I mean, that's plain and simple. Anybody can see this big bullish candle. So if I'm down on the lower time frame, I'd like to look at 2 things. Obviously, the first one is the trend, but then the second one is something that I like to call candlestick maturity. So if the weekly time frame is bullish, I'd obviously want to continue with that trend. But the overall idea is, where do I get in on that trade idea? So my overall idea is for the candlestick to flip together with the weekly momentum. So we already know that the weekly candlestick is bullish, and we can already see that we're creating higher lows. If you want a clearer picture, just drop down to a lower time frame. A lot of traders overthink this. They think that there's some secret recipe towards how you need to drop down to lower time frames. I believe quite the contrary. I actually think that you need to make trading a lot more simpler than it is. Not dumb it down, but just make it simpler, and the simpler the better, obviously. So we can see that these 2 points are touching what I like to call a trend line. Now, a trend line is a basis point consisting of 1 touch or 2 touches. I used to trade trend lines for 3 years actually. Why did I stop trading them? It's just because in trading you get dynamic and you get static. So you get dynamic points, which is obviously changing, and then you get static points, which is staying the same. So the way I trade right now, which I'm going to show you, that combines the dynamic and static together so that I can stay ahead of the market with the dynamic variables, and I can stay inside of the current market movement with the static variables. But not to bore you too much with that, let's stay on track with what we're talking about right now. So I know that the weekly time frame is bullish. Daily time frame, I'm now waiting for that bullish push. So I'm either going to wait for as simple as that, my 3rd touch on the trend line, we can wait for that. Or on the H2, I know a lot of traders that use Fibonacci sequences. They use Fibonacci levels, and then they wait for a key area to be tested. But we'll jump a little bit more on that a little bit later. My overall idea right now is I want structure to break. As we said in the beginning, we can see that the market is trending upwards, right? But when you look down on the H4, on the H1, it's very evident that the market is pushing bearish. So what you want to do as a trader is you want to try and understand where you can get in on the market for all the time frames to align with the same picture. There's no point in you getting in on this smaller correction or move right over here, because let's say this is the daily time frame, and then inside of this smaller correction right over here, that's the H1 time frame movement. So you want the H1 time frame to align with the daily time frame. That's in essence what you want to do. And right now, that's not the picture that's being painted. Let's go down to the H1 time frame so that it's pretty clear. We can see that the market is pushing down. So in natural fact, this is actually not a trending market right now, because the daily is bullish, as we all can see, high, low, high, low, high, low, high, low. That is what structure is telling us. Structure is the language of the market. Structure is telling us, listen, the market is pushing up or the market is pushing down. Where am I getting in? Where am I going to exit? So we can also see that the weekly is bullish. I mean, there's no doubt about this, that the market is bullish. So of course, if you want to sell right here, that's going to be called counter trend trading. Can you do that? 100% you can do that. But it's going to be a lot more risky, because you have all of this volume being backed against you, and a lot more traders want to go long. Now, at this point in time, if you want to take a trade, you have to look at a dynamic variable or a static variable. One of my favorite that I like to have a look at, we already pointed out the trend line, it's a very easy to use one, is I like to look at the exhaustion points. Now, exhaustion points is exhaustion areas where you can see the wick. We all know that a candlestick looks like this. Let me draw a prettier picture. We all know a candlestick looks like this, okay? So what I want to do in essence is I want to understand why the market rejected this area right over here. That is called an exhaustion to me, because that means that there was a lot less volume in that area. So what you want to do right now, and this is probably one of my best tricks that I found in trading that works for me, is after you've gotten your exhaustion areas, you've gotten your wick touches from top to bottom on the H1, H2 and H4, and this is something that has saved my trading a lot of times, is I like to have a look on the daily time frame. I like to draw the highs and the lows of the bearish candle, the last bearish candle, because we want the market to go from this to this. We've already established that. So the daily is going up, the weekly is going up. We now need the H4, H2 and H1 to go up as well. So what I simply do is I just track the high or the low if we're going bearish, but the high of the last bearish candle for the downtrend or the correctional move. I take that exhaustion area, because 9 times out of 10 it's going to be an exhaustion area, and then I simply just wait for the market to break and close above, and then that's when I'll look to take some buys. And 9 times out of 10 as well, you'll see a pretty clean range to the left. So of course you can see we have resistance over here and we have resistance over here. Now you're probably going to ask me, hey MC, how do I deviate from taking trades for it to be stuck in that range? And it's very simple. You mainly just want to try and trade in high volume areas or high volume time zones, such as pre-NY, NY session or NYAC open. London also gives a few big moves, but I mean, not unless it's backed by fundamental data from the previous NY session. Okay, so that's trend following. Point number 2, and we already touched on this, is counter trend trading. Now, counter trend trading goes a lot hand in hand with scalping, because as I said before, you do not want the overall volume to be against you for too long. Now, with counter trend trading, you mainly just want a basis point. So we have the market pushing bullish, we have this consolidation, and we already know that we need to break above this area for buys, and this is going to be our 9 out of 10 probability setup, because that's with the overall volume. But that's not to say that you need to sit on your hands. I mean, I personally like to sit on my hands to wait for the best optimal setup, But the second type of strategy that I'm about to talk today is counter trend trading, and that is very contradicting versus trend trading. You just have to make sure that you understand what the overall trend is at all times. It's like crossing the road. When you cross the road, you know there's cars coming, but you got to get to the other side of the road. So exactly the same with trading. You know that you got to take some trades, you got to make some money. You know that this trend is bullish, but still you want to take some shorts. It's exactly the same in my opinion. So what I like to do when I'm counter trend trading is I like to look at areas of interest. Now when you look at areas of interest, it's pretty plain and simple. Already discussed it for you guys in the very first topic of this video. You grab the highs and the lows of the candlestick of the day, because the same thing you'd want to wait to break for buys is the same thing you'd want to be respected for sells. Pause and rewatch that because it's a hidden gem. So on the H1, we already understand that this high right here was an exhaustion zone from the previous day, or as well as a high of the previous day. So what I typically like to do on the 30-minute is I like to grab engulfing candles, bullish to bearish, and take some longs or shorts and scalp this market out. I like to take 50% of the stops, take profit to the high of the exhaustion area. This was a beautiful buy you could have caught in Asia session. This was of course with the trend, but then if you want to go against the trend, you can take this bearish engulfing down to the next exhaustion area. You can just paddle your way back and forth between the range, because until that range is broken down into or broken above, you need to wait and sit on the sidelines, or you can try and make some pennies with scalping. The third strategy I like to talk about today, and it's not really a strategy but more a general topic of discussion. We already discussed trend trading, counter trend trading, dynamic and static points, but after that I want to talk about the baseline, the basis point. So you got your strategy, you already discussed, are you going to go long, or are you going to go short, are you going to stay with the trend, or are you going to go against the trend? And then after that you need to find a basis point. Now I already touched a little bit on this, but the basis point consists of, for me personally, it's either a trend line touch, exhaustion point touch, moving average, or one of my favorites, the equilibrium. So the equilibrium consists of taking the previous daily movement from the high to the low, and you grab the overall middle of that range. For example, I'd like to have a look at this day, the 12th of June. I take the movement from the low to the high, and that's my equilibrium. Now that's going to be my basis point for the following day. So if the market is above that, the traders are paying too much for their current instrument. If the market is below that, the traders are paying too little for that instrument. So what I like to typically do is at the start of every day, I like to grab my equilibrium and make sure I know what's up for the following day. So on the 13th of June, on a Friday, we saw that the equilibrium was pointed at 3415, and then the following day, a Monday, which is the 16th, we can see that the market broke down into the equilibrium, consolidated for quite a while, and then after that the market just broke down. That means that they were grabbing orders here at the equilibrium. It's a constant battle of back and forth. The price is too high or the price is too little, and then all of a sudden when the market grabbed a fundamental idea, because you always need a fundamental idea, the market came crashing down, and guess to where the market got stability? To our very own exhaustion point. Let's go to the 1 hour just so you can see it clearly. Look at this beautiful old trusty exhaustion point down at the bottom at 3382. So that means the market was constantly breaking highs, because we already considered this as an uptrend. It gave us our false break reversal right over here. The market came pushing down, battling it back and forth at our equilibrium. The market came crashing down after it already dictated we're in shorts for the rest of the day. It came down after the fake out, and it tested our exhaustion area. Now as you can see, this very strong exhaustion area held for the following 2 days and it's busy holding today. So my game plan for today, my basis point, is the first thing I'm going to do is I'm going to grab my equilibrium and I'm going to play the market back and forth today between the equilibrium, above the high of the equilibrium, below the low of the equilibrium, and I'm going to try and anticipate market movements based off from that. So just to recap, I know it's a lot of back and forth. You're either trend trading or you're trading against the trend. Those are your two things that you need to understand when you get to the market at that very day. The last thing you want to do is then understand your basis point. Are you using Fibonacci points? Are you using order blocks? Are you using exhaustion areas? You need to find a basis point or your area of interest where the market tells you, okay, listen, this is interesting. I'm going to take some buys or I'm going to take some sells. You take then that idea mixed with point number 1 and point number 2, which is trend trading or counter trend trading. And then you ask yourself, is this area of interest going against the trend or am I going with the trend? Then you've got an overall trade idea. So that's it for today, folks. I hope you liked this video. I hope you learned a lot. I'll see you guys in the next one. Peace out.